Hello, everyone, and welcome to today's webinar, the newest Form 941. I'm Yonina F. Scheinweather, CPA, the Consulting Director of Compliance at Viventium, and together today, we're going to work on understanding the latest changes to your quarterly tax returns. Now, this webinar is called not the new Form 941, but the newest form. And as one very astute industry pundit said, we're dealing with more payroll changes, forms, legislation, guidance, rules than we've probably seen in the past half century in just this 1 year. I'm sure those of you who have, been following closely what's been going on with payroll, which is almost every employer, between PPP loans, various changes to forms, and now the reissuance of the 941, which has been already twice this year. Our heads are kind of spinning from all the changes. And what we're going to look at today is not just the changes, but the latest changes, because it has changed again. And therefore, basically, I'm going to be dividing today's webinar into two sections. Stage one, we're going to discuss the original changes from first quarter 2020 to second quarter, third and fourth. In other words, there had been a first quarter form and it was changed for the remainder of 2020, or at least that's what was thought at the time, that the new form would be used for second, third, and fourth quarters. Those changes were inspired by three laws, FCRA, CARES, and PPP-FA. The COVID-19 relief provisions contained in those laws were reflected in the new 941, which of course is the quarterly tax return that all employers file. And therefore the form was changed for the remainder of 2020, and everyone thought it was going to stay, second, third quarter the same. However, President Trump signed an executive memorandum which created further changes and further IRS guidance, and thereby necessitated changing of the form yet again between second and third quarters. So the form that was used in second quarter is not the same form that's to be used in third and fourth quarters. And that's what we're going to talk about in stage two of today's webinar, the latest changes to the 941. So we're going to start with stage one changes and take a look at what FCRA, CARES, and PPP-FA did to the 941. Now, I just want to put in a little word of explanation here. Some of you may be saying to yourselves, well, I didn't have any employees who went out on FCRA, and I didn't take a PPP loan, and I don't have any employees on retention, or all the things that people talk about when they talk about the CARES Act. So I can just use the regular 941 without any changes, right? So unfortunately, it's wrong. Everyone must use the new and revised 941, even if you're not claiming any of the credits or taking advantage of any of the COVID relief provisions. The form has changed for everyone, and therefore, as a best practice tip, you want to be sure to reach out to your payroll providers, or if you're using off-the-shelf software, customized software, whoever your partner is, and make sure that they're supporting the new form. And the newest form, of course, I can tell you that Viventium is. Those of you who are Viventium clients, you know that already. But it's not like you can just kind of tune out and say, well, COVID-19 didn't affect my payroll, so I can just go ahead my merry way. No, unfortunately, everyone has to be using the new 941, and systems have to be able to support all the new lines because there are many of them. And here they are. So in stage one, again, what we're looking at here is the first quarter 941 compared to the second quarter. In first quarter of 2020, that was pretty much before COVID, we thought that this was going to be the form. Looked like any other 941 for a plain vanilla year, a plain vanilla 941. It looked pretty much like the 2019 941, except that it said 2020 at the top. And as you see, it says that the form can be used for all 4 quarters, January through March, April through June, July through September, and finally October through December, and everything seemed hunky-dory. Then came COVID. It was actually, some of the COVID legislation was still passed in the first quarter, the original FCRA and some of the original provisions in CARES, but the IRS did not revise that first quarter 941. They said, we're not doing it so quickly. So whatever loose ends need to be tied up for first quarter were tied up on the second quarter form. But COVID happened and the IRS issued a brand new 941 with more changes, like I said, than we've seen in the past half century. Lots of new data items and a whole brand new page. So we need to understand these because these changes are still even on the latest form, just in somewhat modified. So we need to look and understand them. So first thing you'll notice up at the top of the second quarter 941 is that first quarter is grayed out. You cannot use the second quarter form for a first quarter. Instead, it's just for April through June, July through September, October through December, or at least that's what was thought at the time that the form was issued. We thought it was going to be for second and third quarters. In practice, it ended up being for second quarter only. The third and fourth quarters are very different, but for second quarter, this was the form. And the new data items are highlighted here on red on the slide. In the olden days, we used to have a line for taxable Social Security wages and taxable Social Security tips. Well, comes COVID, and first of all says taxable Social Security wages does not mean what it used to mean. It used to mean all taxable Social Security wages, just like its name says. Now it means something else. Even though it's called taxable Social Security wages, it doesn't really mean taxable Social Security wages. It means taxable Social Security wages except for any wages that were paid because of the FCRA law. In other words, if you had employees go out on leave because they were sick or they were quarantined or they were caring for a child who was sick or another who was sick or quarantined, that's called qualified sick leave wages. And that would be spelled out separately on the first red line over here. And similarly, if they were caring for a child whose place of school or place of daycare was closed, they're entitled for 10 weeks qualified family leave under FCRA for that, paid up to certain limits. That also must be specified separately. And you might wonder, well, why did the IRS do that? Why not just put everything under taxable Social Security wages? The answer is because FCRA said that any qualified sick leave or qualified family leave, which is sometimes called qualified child leave, so don't get mixed up. Family leave, child leave, it's the same thing. Any of that qualified FCRA leave is not subject to employer Social Security tax. It's exempt from employer Social Security. That's why you'll see when we figure out the tax amount that goes in column 2, we only multiply by 6.2%, not by the full 12.4% like we do on the top line. So 12.4% applies to all Social Security wages except for FCRA wages. And FCRA wages, we're only going to show the employer half. I'm sorry, the employee half, because it's exempt from employer tax. That was part of the FCRA. And then similarly, down at the bottom, we have 2 new lines highlighted here in red. And they show something called the non-refundable portion of credit for qualified FCRA, that's sick and family wage, and also the non-refundable portion of the credit for the employee retention wages. Now, by the way, Viventium has some nifty webinars on these FCRA wages and these employee retention credits. I'm not going to get into the details now, but I will invite you to visit viventium.com and go to our webinars page, and you can also check out our COVID-19 resources page. You'll find lots of helpful information and some additional recordings there about FCRA and about employee retention, just what those credits are, what the limits are, who's eligible for them. But for now, suffice it to say that here's where you get credit for any FCRA wages you paid to your employees. In other words, let's say you had an employee who said, I'm suffering from symptoms of COVID-19, I'm taking time off. And you paid them pursuant to FCRA just as you were supposed to. You paid them up to the appropriate limits, their wages. You don't have to pay that from your own pocket. The IRS, actually the law says that you will get a credit against amounts that you owe to the IRS. So it's in essence as though the IRS is paying those FCRA wages for you. The Treasury Department is paying that for you because any amounts that you paid under FCRA become credits that you do not have to pay in to the IRS. Those amounts are subsidized. They're offset against any of your federal liabilities. And here's where you get the credit, or at least the non-refundable portion of the credit, which we'll define in a little while. But here's where you calculate it. And then the next page, page 2 of the 941, used to just have some detail about your monthly breakdowns of your liabilities, or if you were a larger employer, you had to file Schedule B, and signatures and stuff like that. And that was the end of the form. It was a 2-page form. Well, now in the second quarter, page 2 changed very much. There's a whole section here where most of the information is COVID related. First of all, we're being asked to put down the total non-refundable credits, and we'll define what those are soon. And then your total taxes, total deposits, and then something new, line 13B, deferred amount of the employer share of Social Security tax. Now, this is not connected to the fact that escrow wages were exempt from employer Social Security. That's something else. That was exempt. You didn't have to pay employer Social Security. But in addition to that, the CARES Act said that you're allowed to not pay in any of your employer Social Security taxes right now, but they're only deferred. They're not forgiven. They're not exempted. You're still going to have to pay it back, half of it at the end of 2021, half of it at the end of 2022. Once again, I want to invite you to listen to one of the Viventium webinars explaining the employer deferrals and the other COVID-19 relief. But this is where it happens. This is where you can say, well, this is the amount of Social Security tax that I didn't deposit because I'm taking advantage of the employer deferral. That goes on line 13B. Similarly, any refundable credits for qualified sick or qualified family, meaning FCRA leave, and any refundable credits for employee retention are also included here. Now, what's the difference between non-refundable credits that we saw on the first page and refundable credits? Well, we'll get to that. But here you have it. You have all the deferred Social Security and your refundable credits. You add everything together, and that's your total deposits and deferrals and refundable credits. And from that, you subtract any advance credits that you've actually gotten from the IRS by filing Form 7200. Now, Form 7200 was a brand new form due to COVID-19. Once again, there is separate Viventium webinars about Form 7200, but just in very brief, if you didn't want to wait till the end of the quarter to get your payments from the IRS, your credits, let's say you already offset all your taxes, you have nothing else to offset against, and there's still money that the IRS owes you for all these various credits, well, you could request that money in advance by actually faxing a form. The first time the IRS had the only way that you could file a form was by fax, just a sign of the incredible times that we're living through. By faxing Form 7200 to the IRS, and then they would mail you a check, only a paper check. There was no provision for electronic payment. And I know at Viventium, we've had numerous clients receive Form 7200 advance refund checks. Those of you who are not with Viventium, I hope you've had the same experience, that anytime you sent in a 7200, you were able to get those payments back. So any advances that you actually received already get subtracted, get offset against your deposits and credits. And then the remainder, of course, is either a balance due or an overpayment, depending on your numbers. And then you have to give your monthly liability breakdown or your Schedule B. Now, we're not done, because in the second quarter, the IRS actually launched a brand new page with further COVID information requested. Starting here on line 19, qualified health plan expenses allocable to the qualified sick leave wages. When we spoke about the credits that you were allowed for FCRA wages, we only spoke about the amount of wages you actually paid to the employee. However, you can also get a credit if you continued their health coverage. If you paid their premiums for their health plans while they were on FCRA leave, you again don't have to pay that out of your own pocket. The IRS, Department of Treasury, is picking up the bill. They said just offset that against whatever you owe the IRS, and if there's anything extra, you'll get it back. And that was included in the credits on the earlier pages. However, the IRS says, we're not going to give you that credit back. We're not going to give that to you unless you tell us how much it was. We want you to break down how much was actually the health plan expenses that were part of your FCRA wage, how much was the health plan expenses that were part of your family leave wage, how much did you pay to begin with for employees who are on retention, and how much did you also pay for their health plan expenses. So unless you complete all these lines fully, your returns will be delayed and your credits can be either delayed or placed in jeopardy. So it's very important to check with your provider that they support this new page of the 941 and that they're filling it out for you. And then finally, the last two changes, lines 24 and 25. Well, if you remember at the beginning of today's webinar, I stated that there was some unfinished business from first quarter because COVID relief was already passed in first quarter, but it wasn't passed fast, there wasn't enough time, let's put it that way, for the IRS to revise the first quarter 941. So they just said if there's anything left over from March that we need to know about COVID, we're going to ask for it on the second quarter return, and they did. But I'm not really even going to go into detail here because that was second quarter only, and that's water under the bridge and history. So we're not going to spend time on that. As we will see in the latest form, those lines have disappeared. So now we enter stage 2. And these are the changes between form we just looked at, the second quarter, to the third and fourth quarter, the forms that we are used for the remainder of 2020. And these changes were inspired by the presidential executive memorandum that the president signed, authorizing and directing Treasury to allow employers to defer the employee share of Social Security. Remember, we had said earlier that employers were allowed to defer the employer share. Well, the newest change was that employers were allowed to defer employee Social Security as well. Now, once again, it's not a forgiveness, it's only a deferral. And the amounts must be withheld and deposited in the first 4 months of 2021. So again, any amounts between September 1st and December 31st, those are the magic dates, September 1 to December 31, 2020, any amounts of employee Social Security may be deferred. It's kind of like a short-term loan that the government is giving to employees just to, help their cash flow at times that they may need it the most. But any of the amounts that are deferred between September 1 and December 31 must be withheld by the employer and repaid or deposited from it within January, February, March, and April at a ratable rate, meaning there's 4 months of deferrals and you have 4 months to pay it back. Now, of course, that raises questions like, well, what if your employee no longer works for you? Or what if you can't collect it from them? And that's been, the part of a lot of discussion, but the basic consensus right now, according to the latest IRS guidance, is that the employer would be held responsible still for depositing those employee amounts if they can't recoup them from the employee. Now, what many employers may consider fortunate is that this is optional. You don't have to offer the employee Social Security deferral to your employees. If you're afraid that you may be left holding the bag or you just don't want the administrative headache, it's your choice as an employer whether or not you're going to offer this deferral. And similarly, as an employer, the IRS said you can even leave the choice up to your employees, because some employees may say, one second, I don't want this. Like, I just want to pay my Social Security as I go along and get it over with, because if I have to wait till January, that may be at some of the hardest times, when I've just done a lot of spending and I don't want to have double withholding, pay my regular Social Security and also pay the Social Security that I owe for back in September 1st through December 31st. No, thank you. So employers have really the flexibility to skip it altogether, or to do it, mandate it, and not leave it up to their employees. Yes, we are withholding. Matter of fact, the federal government said we are deferring, not withholding, we are deferring all federal employees Social Security. We're not giving you a choice, we're just deferring it. The third choice employers have is to leave it up to the employees to choose. Now, at Viventium, we support this as an employee by employee choice. I don't know what other vendors are doing, but you may want to check with your payroll providers to see what kind of flexibility they are allowing. Is it a blanket decision, the employer either opts in or opts out, or do you actually have the flexibility to offer the deferral on an employee by employee basis as the IRS guidance allows? In any case, because of this employee deferral, we now have a change to the form. Now, what we're looking at right now is a draft as of August 28th. This on the left-hand side is the form that we looked at before, the second quarter form. And now on the right is the newest 941, which is to be used for third and fourth quarters only. So the first thing you'll notice is that up here where we have the months in the upper right-hand corner, we now have the first 2 quarters grayed out, January through March and April through June. And then there were 2 left. So this can only be used for July through September or October through December. Another change highlighted on the top of the form is that when it asks for the statistical BLS count of that's Bureau of Labor Statistics count of your employees as of the 12th of each month, it specifies either September 12th or December 12th, because the earlier 2 quarters don't count. So that's just a little bit of cosmetics that they did to the form. Now, all these changes that we saw before that I had spent some time explaining still apply. So that we still have, qualified sick leave broken out separately, qualified family leave, it's still 6.2% because only the employee pays Social Security on EFCA wages, not the employer. We still have the non-refundable portion of the credits at the bottom here, these last two lines, 11B and 11C. When we move on to the second page though, 13B has changed. Before, it allowed us to put in the deferred amount of the employer Social Security tax. Now it just says deferred amount of Social Security tax. That means if you deferred any of your employee taxes and you also elected to defer your employer Social Security tax, you'd put the total on 13B. They're not asking for the breakdown here on this page. Here they just want the total amount of Social Security tax you deferred, either that was employer, which is under the CARES Act, or that was deferred pursuant to the Presidential Executive Memorandum, which would be the employee tax. So that's a change to page 2. And then finally, page 3. Remember I told you those last two lines, 24 and 25, were for second quarter only, just cleaning up some unfinished business left over from first quarter. So they actually took those two lines, they changed them totally. They said we don't need them anymore because it's not second quarter. Line 24 is where they want the breakdown. They want to know how much of line 13B was the employee deferral. So again, this is, you just want to make sure that your software packages or your vendors have the capability of breaking out separately the employee share that was included in the total deferral on line 13B and putting that on line 24. And line 25 is right now just blanked out, reserved for future use. They don't want, I think once they create a line on a form, they don't get rid of it. They just kind of reserve it for future use. That just sounds kind of ominous what that might be. But for now, it's just reserved for future use. So there you have it, folks. You have the latest form. And now I just want to, spend some time defining some of these terms we've been using. So we already know that the new meaning of taxable Social Security wages is not taxable Social Security wages. It's taxable Social Security wages minus EFCA wages. Okay, that should be clear, and that's made clear in the instructions. I really would have liked to see them. I mean, I have to, really give the IRS credit. They did a yeoman's job of taking an incredible amount of legislation and guidance and getting it all in a form. It would have been nice maybe if it could have said something like, taxable Social Security wages net of EFCA or something, but okay, they chose to leave that the same, but we have to know that the number that's placed on that line is not the full taxable Social Security wage, it's that amount minus EFCA wage. Qualified sick and qualified family wages, again, these are amounts that you as an employer are obligated to pay your employees, and exactly which employers are obligated and how much you have to pay them during this EFCA leave, what the limits are. That again, I would refer you to one of the earlier Viventium webinars, but that term is used again and again on the 941, and they both refer to EFCA wages. The employee retention credit was enacted by the CARES Act, and it said that if you keep employees on your payroll, even if they're not working, and in some cases for small employers, even if they are working, you get a credit of up to 50% of what you pay to offset all of your taxes. And that's what you get on the 941. Now, the distinction between non-refundable and refundable credit. This is important. Non-refundable credits kind of sounds like a credit that you don't get, but it's not. Or sometimes we're used to thinking of a refundable credit as a credit that we get even if we don't have tax. Well, that's how it's used on personal tax returns, but that's not really how it's used for COVID purposes. The only difference between non-refundable and refundable is the credit that Congress actually legislated. That's called the non-refundable credit, and that says you can offset all of your credits against your Social Security, your employer Social Security taxes. That's called the non-refundable credit, the portion that Congress specifically said. The refundable credit is the amount of the credit that you offset against everything else, meaning Medicare taxes or employee federal income tax withholding, anything that Congress didn't say, but that logically the IRS said you should be able to offset against as well. So they're just two sides of the same coin. You get every single penny of your non-refundable credit. Don't be deceived by the name. It does not mean a credit that you don't get. It simply means the portion of the credit referenced in the actual legislation in Congress's wording. And the refundable credit, you still get the same amount, no difference. It's the same credit, you get whatever it is, but it's offset against additional deposit liabilities that the IRS is allowing you to use. Deferred amount of Social Security tax, well, we know that's comprised of both an employer portion and now an employee portion, and they have to be broken out on the return. And as we mentioned, qualified health plan expenses are also included in your credits, whether they were paid to employees on qualified sick or family leave or on retention. And the amounts must be reported separately on page 3 of the 941 in order for you to obtain them as credits. Just a last point before we wrap up for today, and that is, I've mentioned the new form 7200, which you can fax to the IRS to get advance credits. And here on line 13F of the form, it tells you to put down the total of advances from the 7200. So you might think that you should take, all the line 8s of all of your form 7200s, which are your advances requested, total them up and put them on line 13F, right? It says totals of 7200. So no, that's not what it means. Do not report the line 8 totals from your 7200s on line 941. Let's look carefully at the words. Total advances received from filing form 7200. Only report IRS checks that you actually received. Meaning you may have sent in a few 7200s during the quarter and you haven't gotten those amounts yet. They do not get included on 13F. That's probably one of the biggest errors that employers are wont to make. I'm just pointing that out. They only want to know the amounts you received. Now, of course, that raises questions. Well, what if after I'm, send in my 941, the next day I get a check? Well, do you have to rip it up? Do you keep it? What do you do about that? So, of course, that's something that the IRS is not quite clarified yet. But what they have made very clear is that the amounts that you put on line 13F are only the checks that you actually received from the IRS. And I want to thank you all very much for participating in this webinar today. And once again, I want to stress the importance of visiting viventium.com because it's just chock full of information that is useful about anything payroll-wise, but especially our COVID-19 solutions page. You'll find lots of great resources over there and our webinars page as well. I want to thank you once again for your time today and wishing you all much success in complying with all of the new and newest laws of COVID-19 relief. Thank you and have a great day.